So now switching from local things, let's go talk about what the stock market is doing this week and what to expect. So today we saw on Monday there was no holiday or anything, so the market was open. The market is open from 9:30 to 4 on Monday through Friday for the US markets. And I expect the market to rise this week. There is a lot of earnings calls happening. A lot of company earnings are being reported, as well as a lot of economic indicators, and the economic calendar is full this week. So when you look at today, I'm going to go just Monday through Friday about what you can expect on the stock market this week, because today the Nasdaq gained about 2%, the S&P was up, but and the S&P was up because of the report that came out today, the leading indicators report. It was expected to be a minus a points negative 0.7%. Last month it was negative 1.1%, but it actually came in at negative 1%. So Leo, be the line. What does that mean about leading indicators report? Like what should that tell me about my money in the stock market? Well, what it tells you is that a leading indicator is basically like what happens before the market drops, or what causes, or what indicators can you see 3 to 6 months ahead before economic downturns or before economic upswings. So say, for instance, I'll give you an example of a leading indicator. A leading indicator for the market or for the economy is the stock market. So if you see the stock market dipping into a recession for 2 straight quarters, chances are the overall economy is going to do that, but in about 3 to 6 months later. So that's what a leading indicator today is. And so it said that in the leading indicator reported that it was actually down 1%. And that shows that the analysts believe that, according to this report, that the market will be down, that we might be facing a recession towards the springtime, towards the summertime. But I'm a little bit more optimistic because they don't believe in as much of the Fed's ability to tamper down the inflation. Inflation has run rampant for about a year and a half with gas prices, everything. We're talking about eggs. I've seen so many memes about eggs, man. It's just like, come on, dog. Can we come up with some new material over here? Like, yeah, we get it. Eggs are expensive. Okay, cool. Cool beans. So when we talk about the leading indicators report, it was down. The majority of the analysts believe that there is a recession coming, but I don't believe so. I think that with the interest rates hiking, there is always a point that you can overheat the economy by raising interest rates too fast and causing inflation will go down, but the economy will stagnate. It's almost like if you have an overheated car, you can't drive the car once it's overheated because it's just smoking. So if you raise rates too quickly and the economy overheats, yeah, inflation will drop, but more people will lose their jobs. More people will not be able to have savings. More people's credit cards interest rates will go up and cause people to have higher levels of debt. More people will not be able to afford a home, things like that. So the Fed has to be careful about how they raise interest rates. And the Fed's only tools that they have to help the economy or to hurt the economy, the only tools that they have is they can raise or lower interest rates, or they can increase or decrease the money supply. So right now the Fed is working on raising the interest rates to balance out this inflationary economy. On Tuesday, we have the S&P Manufacturers Purchasing Managers Index, and what that shows is they take a basket of businesses from all over nationally, and they speak to those businesses that are part of the S&P 500, those manufacturing businesses, and they speak to the managers and ask them about, how have your inputs been? Have your inputs been increasing? Does it cost you more to produce your product now? Is your fixed costs, are your variable costs rising because you have now more inflation? And does it cost you more to borrow out of your accounts payable and things like that. So if you are sitting there, you would want the manufacturer's PMI to be reduced. But in my opinion, and I firmly believe that tomorrow we'll see the S&P manufacturer's PMI be greater than the anticipated number. I believe that the costs are going up for businesses and have been up for about a 6 months time. And seeing that, you can see that all the prices have gone up around you. Where, like I did mention, it does cost more for eggs. It costs more for gas. It costs more for clothes. It costs more for a lot of baskets of goods. Then after Tuesday's manufacturing report, there's nothing on Wednesday, but expect usually when there's nothing on the economic calendar, expect earnings calls to occur. You can see that usually they kick it off. It's almost kicked off alphabetically, so we have a lot of like Alcoa, and they're an aluminum company. You have different companies that start with A that are probably going to be going off soon for earnings calls. On Thursday, we have the jobless claims, and that's basically the unemployed report. The jobless claims report basically shows how many people have filed for unemployment or filed for employment protection over the past month. And what that's actually expected to decrease. The economy is running relatively hot right now. It's not overheating, but it's running relatively hot right now because those who have a job are employed, obviously. But those who don't have a job, if you're not actively searching for a job, and when they do the report and they say, "Oh, are you actively searching for a job?" and you say yes, then they count you in the unemployment report. But if you're not actively searching for a job, say you're retired, or say you have your own side business thing, and they're like, "Are you actively searching for a job?" and you say no, you're not included in the unemployment report. So just a little bit of color just to give you so you can kind of understand the unemployment report. I expect the jobless claims to decrease from last month. There's a lot of open available jobs. It's just a question of whether the wages are enough. When you look at any job website, there's myriad of jobs available. I work for Palm Beach County. I'm a financial analyst, a head financial analyst for the fixed assets division. And right now, within Palm Beach County, we have at least 50 jobs available, ranging from the entry level to director jobs. So there are jobs out there. It's just the question of, are people actively searching for employment, or are they not? Because if they're not going to be included in unemployment numbers. And I firmly believe that unemployment can be deceiving, especially in this type of market where things are expensive. You know, a lot of people might not be looking for a job. They might be happy, where similar to the unemployment spike during Corona, during the pandemic we had, where people were happily and rightfully so, they said it would cost more to go look for a job than to get unemployment benefits. So they were happily accepting unemployment instead of having the job. So, but for right now, I do expect the jobless claims to be reduced this month from last month. You know, December is usually kind of a big hiring time for retail environment, for service industry, because of the holidays. So I expect maybe they were in a hiring mode November, December to reduce those jobless claims. Then after that, on Friday, we have two important metrics and two important indicators for the economy, and that is the consumer spending report and the the consumer spending report and the pending home sales. So first of all, with the consumer spending report, this takes a look about, it's kind of self-explanatory, but it does take a look about how consumers are spending their dollars. Are consumer debt levels rising? Are consumers trying to save more, or are consumers trying to rev up the economy and basically having a spender mentality and trying to consume in the economy? This is very important because you see in times of recession that consumers' borrowing abilities and consumers' credit spending can right before a recession, the credit spending usually spikes because they're not making as much money. The economy's slowing down, so you have to use more credit and go into debt a little bit further, and that can be exacerbated if we fall into a recession. But I believe that consumer spending is up. Like I alluded to with the South Florida Fair, the amount of traffic that I saw at the South Florida Fair being backed up on Southern for miles, being at the fair, seeing how crowded the lines were, seeing how crowded the food lines were, seeing how crowded just walking through the fair, and it seemed more crowded than usual. I believe that the economy, especially in the South Florida area, is booming right now. We have consumer spending. I'm looking out. Leo Be the Lion Show. I record live from 5 to 6 here at Respectable Street, and I see tons of people walking around on Clematis. I see people at Kapow and stuff, and eating and just enjoying life. I see a lot of nice cars running around, so people are spending their money. So I do expect the consumer spending report to really increase and to show an indicator that consumers are not saving as much because they'd rather spend this money now that because of interest rates being so high. Then talking about pending home sales. This is really important because with the higher interest rates, you would expect home sales to be reduced. When we were having record low interest rates under 3.25, 3.5, you'd be more willing to borrow money as a 30-year fixed rate if you're doing 3.5% than if you're borrowing at 7%, 7.1%. And that actually cuts your ability to borrow almost in half. If it's double the interest rate, say you could only get approved for a $200,000 property with a 3.5 interest rate. When it comes down to if it's a 7-point interest rate, you could probably only get approved for $100,000 in your property. So it's very important to pay attention to the interest rates if you're looking for a house. And when we're talking about pending home sales, those are homes that are under contract. And now that we've seen the rates rise and the investment isn't as such a good for speculative investment in real estate, we've seen cash deals be reduced, and now more first-time home buyers are entering the market. But the only thing that stinks about that is that the interest rates are higher, so it's harder for those first-time home buyers to get into their homes. And prices are still high from the pandemic time. When you have a one-room apartment selling for $180,000, $200,000, or actually no, I actually know of an apartment right now. It's my girlfriend's apartment. They're trying to say that it's worth $350,000. Don't tell her landlord that, because I don't want her to get kicked out and tell her to sell that thing. But her landlord probably bought that thing in like 2010 for like $60,000. So do you see how much? There's no way on God's green earth that a one-room apartment that's like under 1,000 square foot should ever go for $353,000. So let's just put it out there. The market for real estate is really high in South Florida. It's frustrating because those who grew up feel kind of like, I feel kind of like I missed the boat. But what could I do when you don't have money? If you're a broke college student or if you're a broke high school student, you couldn't say, oh, I'm going to buy these 30 apartments for $20,000 each like the people at Wells Fargo did or the early investors in 2010, 2011 did. We just missed out on that. So we got to wait for the market to go down. But when it comes to pending home sales, I think that those are going to be lower for this report because normally in the wintertime, there's not as many home sales going on as the summertime. Summertime's a little bit hotter when it comes to the real estate market.